Hi everyone and welcome to Symax Fintech's weekly market insight. First, a disclaimer. So trading involves the risk of loss of capital. It's not suitable for everyone. As I say every week, hopefully it is for you. Many companies provide leverage. Just be careful with that. You can lose substantially more than that initial investment. It's better these days because of regulation, but it's still not perfect. So always check the small print. Views, opinions, everything contained in these purely for educational purposes. We're not trying to encourage you to trade or invest. That has to be your decision. And of course, to do that, you must decide on and consider the risks, your financial situation, your level of experience, most definitely, and of course, your risk appetite. And most importantly, you should only risk capital you are prepared but can afford to lose. Don't put yourself in debt. Make sure you've got plenty of savings to cover yourself. Depending on what you've got, consider as a suggestion, purely a suggestion, 10% max. You don't want to be risking too much of your capital with trading. Any doubts whatsoever, seek independent financial advice before you start risking that capital. Okay, so last week was very interesting. Stock earnings were still a bit mixed. We had the Fed that raised rates for a record consecutive fourth time of 75 basis points. They're now up to 4%, so they've played catch up quite well, I suppose. Of course, the increases are expected to slow down, maybe, not so much as aggressive, but they will continue for longer. They're determined to beat inflation. They want it back down to their desired 2%. Although, the supply chains are the issue, so they may have to settle for 3%. But, they dream of seeing that for the moment. And then, of course, the Bank of England copied and raised by 75 basis points. I thought it was probably going to be 50, but they stuck with the 75. They're now at 3% in the UK. And recession, it's coming. Data's pretty good at the moment. We're leading up to Christmas, so I don't think it's really going to hit home until probably early next year. But even the Bank of England warned that we could have the deepest or longest, possibly both, in the way of a recession for 100 years. And then moving on to NFP, so non-farm payroll was a beat, 261,000 new jobs. But of course, along with that was the fact that unemployment did pop up a little bit. It's been ranging between this 3.5, 3.7%, which is great. Don't get me wrong, that's considered practically full employment for sure. And you can tell that by the amount of jobs that there are on offer. Weekly hours remain constant. Earnings month on month again up, so 0.4%. It's where companies are trying to attract the workers. And then, of course, the USP PMI over 50, so it's still showing growth there. ISMs were lower than expected, though, and the JOLTS increased to 10.7. That's the job openings that are available. So there's still more jobs available. The level of jobs available to the unemployed is actually, it went from 2% down to 1.65. It's now back up to 1.9 again. So that's sort of a little bit of a turnaround there. And of course, we're still seeing Germany struggling at the moment. Retail sales were lower. Part of it is inflation. Part of it is also they're still waiting for supplies to come through. It's still sort of affecting them for sure. And then, of course, we've still got sort of high inflation from energy, from food and such like. In the EU as a whole, we've got core CPI that's hit 5% year on year, and that's up 1.5% month on month, which is big. And GDP, they just managed to keep it from going negative 0.2%. In the UK, house prices dropped almost 1% month on month. and I would expect to see more of that as well. Although PMI was better than expected. Now, Russia had decided not to continue allowing Ukraine to export grains, but then they've had another reversal and they've now decided to allow that to continue. Part of that, I think, is because Russia seems to push their grains out as well, which produces income for them, under the radar, I would guess, I suppose you would say there. China PMI dropped below 50. Okay, above 50 is still growth. Below 50 doesn't necessarily mean contraction. It's really got to get below sort of 43, 44. So it's still not bad. And obviously there's still a lot going on in China at the moment. But what we are seeing is that real estate is still depressed in China. Australia raised rates, but at a much slower pace, only 0.25%. They're now at 2.85%. And Musk began sacking the Twitter staff. I think all the execs all just went probably almost day one, day two. He wants a clean sweep. And also, it's possible he may get rid of up to 50% of employees, and he's going to make them go to the office now, from what I gather. Companies, though, have begin pulling their advertising because there's going to be less stringent focus on what's being said. So, with that being a little bit more volatile, people don't want to be associated with it at the moment, or companies anyway. We'll have to see how that plays out, though. And at one stage, he voiced this new fee that he was going to bring in, which was going to be $20. It now seems as though that's dropped down to $8. But is it worth it? The guy's going to raise probably about $1 million. Yep, we'd all love that $1 million, but it's just $1 million. Considering what he paid for the company, it's a drop in the ocean, shall we say. Okay, moving on to the data that's out this week. We've got central bank speakers. There's inflation data coming out. And then, of course, in the US, that is. And then we've got CPI. So we're going to see some good inflation data there. It's not the best one that the Fed uses these days. They prefer the PCE. But it will give us an insight into what's going on. And of course, consumer sentiment, from Michigan. And again, obviously, that's another key thing. And it just seems to be holding up really well in America, despite the fact that inflation is high. And of course, all of this is feeding in to what promises to be really interesting midterm elections in the US, which are going to be on Tuesday. Are people going to be concerned about inflation? Yes, of course they are. Is it going to be enough to make them vote for the other party, the Republicans, instead of the Democrats? We'll have to wait and see. And of course, you've got the two houses. Will Biden lose one or both of them if it does start to go that way? Now, if you want to know more about that, then Tuesday evening, 5 o'clock GMT, I will be discussing with Tom from Ninja Trader all about the midterm elections. We'll also be covering the macro outlook. We'll be doing lots of technical analysis on a variety of different asset classes. So there's the link there. Join us, feel free to. We'd love to see you there. It will be a very interesting conversation. He's a great guy and definitely knows his stuff as well. And then on Friday in the US, we've got Veterans Day, so that may lead to a long weekend for many. In the UK, retail sales, GDP, industrial production, manufacturing. So again, how's the high street doing? Our retail sales suffering? The UK does love to spend. So it may be costing more, and of course with mortgages going up and everything, but is it feeding into the economies yet, or is it slowly feeding in, or are we just going to ignore it, accept we're paying higher prices, accept it's costing us more if we're lending, and just get on with life? we'll have to wait and see. In China, Europe, I suppose better cover them. Retail sales, economic growth forecast. The economic growth forecast, keep an eye on that. That's a report, that'd be quite interesting. Is it still going to be growth, or is it now actually heading for contraction, and how quickly? That's going to be the question. With China, we've got trade data and we've got CPI. So again, we're going to see a little bit of insight into how their inflation's going. Now we're going to move on to the macro outlook. Inflation, stagflation, the EU's in double digits, UK as well. Obviously, power prices, food prices still massively impacting. And of course, we're still going to see these rates going higher. And, when rates go higher, that has a slight inflationary impact as well. And of course, if we're importing, or any of the countries are importing from the US, it's costing more because of the strength of the dollar. And then, of course, we've still got sort of the recessions that are heading our way, especially in Europe and UK. Personally, I believe they're going to be global. We're not going to get away from them. But what I'm thinking is that, Europe and the UK are going to be hit first. Emerging markets, of course, are going to get impacted by it as well. The US will probably be the last into proper recession, a real recession, not a technical one. And they'll probably be the first out, just because the strongest economy. And I just don't see that changing for any time soon. And then, of course, in the UK, we've got this fiscal tightening where our government's looking to raise or save 50 billion pounds, that is. That's going to be sort of a cut in services, etc., along with increased taxation. So that is not painting a pretty picture for the UK, especially at a time when we're getting hurt and looking already to go into recession. That's just going to put us in deeper and hold us in there for longer by sure. And then, of course, on top of that, we've still got some supply chain issues. You've really got to still keep an eye on COVID as well. It is still around. You're seeing more cases increase. We seem to be dropping off again just a little bit. Last year our government decided to come out with a great statement, or living with COVID, and that's what we're doing. But you read all these medical reports about the long-term impact of COVID and that, which is not so good for people. So fingers crossed everybody is all right. And then the supply chain issues are part of that. With China, with their zero COVID restrictions, although there are rumours that they may actually ease them now. They've got about 200 million people locked down at the moment. But then on the other side of that, we've got container prices, which are back to pre-war levels. However, on Friday, because that rumour sort of came about, you notice gold popped up, oil popped up. So it did have a little bit of an impact on commodity prices, because that will increase demand again. Russian invasion of Ukraine in its 9th month. Russia started attacking the utilities, the power and water supplies in Ukraine, as a little bit of revenge against the fact that Ukraine is regaining a lot of ground and progressing really well. Good on Ukraine, that's all I can say there. Energy prices still increasing. Again, you've got this difference in PPI with, what producers are paying. That's been dropping down, but they're not passing that on to the consumers. So you're not seeing that reduction in CPI. And again, it's a little bit annoying. They've got their profit margins the highest for decades, over 15%. And of course, that's going to keep going for the moment. The biggest sort of tech sector is the tech sector. Obviously they're getting impacted because if we're having to pay more for food and energy, A lot of households have got to make cuts elsewhere. So people are going, okay, I can survive. I can live with this last year's tech for another year. I haven't got to go and buy a new phone. I haven't got to go and buy a new computer or iPad. As long as they work, as long as they do what they want them to do, then they're just going to sort of just accept that they're going to have to wait a year or two before they replace what they're using. You know, of course, they're fashion statements and such like, but you know, priorities are food, energy, you know, keeping the houses warm, and of course, you know, as we're going along now, okay, we had an extended summer in Europe, but that seems to be cooling down now. Now, if that does continue to cool down and sort of drop quickly, which it can do in Europe, then those extra gas reserves that have been sort of stored, which has surprised most, the fact that they've got there, which is great, but it's a matter of how long they're going to last, because, you know, the demand is going to increase for sure. Food prices, I say, remaining a little bit higher still. We've still got that lack of workers, you know, a lot of more people retiring and such like, or the people don't have the right skill set. People are comfortable where they are, you know, and as a recession gets closer and closer, more and more people are likely to say, well, okay, I'll go and earn more money somewhere else, but I could lose that job very quickly, you know, if it's last in, first out scenario. So they may start to sort of ask for less or not ask for more at all, and just be happy to have a job going into the recession. Now the dollar has come off from its highs. It's off about 3 or 4%, and this is on the expectations that the Fed will slowly increase it. But to be honest with you, is that going to make that much difference? Because if they're slowing, the rest of the world are going to slow down their increases as well. Part of it's been competing against the Fed. The other part is competing against inflation. Now, you know, does that mean other countries are going to keep pushing theirs up and up and up? No, I think you're going to see them start to slow down as well. You know, they're going to want to see all this rises that they've made in the markets feed into the data and see what impact it is really having on consumers. You know, the one thing I would say about rates is, you know, cheap money is gone. And you're not going to see those low rates again until there's the next crisis. And even then, you might not see the zeros and all that, because, you know, this has been a bit of a wake-up call for the central banks. They may hold back. They may cut rates, but they may not be so aggressive the next time round because of that. But they're going to hold them higher for longer, because at the end of the day, they've got to get that inflation under control. And as I keep saying and warning people, that if it means pushing the markets, pushing the economies into a recession, they're going to do it. It's the only way they can reset the economy and start again. You know, crash demand, balance it with supply, and then work out what to do. And I can see that quite honestly going into the end of 2023 or even 2024 before there's even any consideration of change of policy. But, you know, that's, again, you know, just remember, that's just my personal view. Now, the other thing we've got, obviously, is with this midterm elections, it's probably going to decide whether Trump is going to run again in 2024. So there's a good chance that he will, which again is great for the market. He's such an interesting guy. You know, God, I could do a whole hour on him, but I won't.